All right, guys, welcome back. For those watching in the future on recording, we did 3 sessions. This is the middle session of the 3. The first one was on order flow patterns. This one, a more general overview of trading central banks. And while I'm doing this, I got to turn down my squawk. I'll get into that and how I kind of get the information on this particular event tomorrow, and that is the statement on our Fed. That's what spurred this event today. So let's get rolling. In case you've never heard of me, you have now. I started my career back in the CME as a high school kid between junior and senior year. I went off to college, came back, 96, got back on the floor. Board of Trade member, was ready to quit the whole business because I couldn't make any money, and electronic trading came around. Got a job at ITG, which became one of the bigger firms in Chicago. And then it led me to kind of back into the educational side, as there was a guy, I'll tell this story real quick. There was a guy in Chicago that hosted a trading room before trading rooms were even known about in like 1999, 2000. And I took classes with him on how to be a floor trader. He would have guys that would fly in all over the world to tour the floor of the Board of Trade. This is before electronic trading took hold and a lot of activity was on the floor. And he says, can I send guys to your office and sit with you for a few hours? And I says, yeah, but just let them know they're not going to be millionaires because they sat with me for a few hours. So I loved it. I loved answering questions and giving guys a sense of how to do this, how to give yourself a better chance. And in this particular webinar, Trading Central Banks, I was afforded, you don't go to college and learn about this. You learn it by doing it. And being in the firm I was in, we had 2 guys that were traders / analysts. They put together a morning wire. They briefed us in the morning. They held meetings before central bank decisions, meetings before employment reports. And that's how I became well-versed in knowing the correlation between fundamentals and how they drove the market. And I'm going to share that as part of today. Now, what we're going to talk about, and I'll leave questions open at the end. This is more just a tutorial on central banks, maybe some detail, but tomorrow we're going to meet again at 12:30 Central ahead of the meeting. Remember, 1 o'clock Central is when they release the meeting. So this one on the Fed, we'll go over some real kind of easy to remember or easy basic stuff about the FOMC, inflation versus growth. Those are their mandates. And then Fed watchers, what markets are most affected and how they're affected. That's what we're going to cover today. So let's get started. FOMC, if you don't know, stands for Federal Open Market Committee. All right. It's our Federal Reserve, Central Bank, Bank of England, European Central Bank, Bank of Australia, Bank of Canada, Bank of Japan, Swiss National Bank. They all have central banks. They're the banker's bank is essentially what a central bank is. So when they move interest rates, it controls money supply. In my career, Greenspan, Bernanke, Yellen, and now Jerome Powell have been the chairman and chairwomen of the Fed. Greenspan up until like 05, 06. Bernanke through the financial crisis, Yellen for a few years, and now it's been Powell for the last year or so. That doesn't mean they're the only people that matter. There's a lot of Fed speakers, a lot of governors, a lot of voters, a lot of non-voters that could say things in between meetings that move the market. Generally, these 4, whoever the chairperson is going to carry the most weight. Now, their number one mandate has always been to fight inflation, to control inflation, to make sure inflation doesn't creep in, because that's an economic growth killer. So that's always been the number one mandate of a central bank. Because they control money supply, too much money means inflation could create inflation. The best way to describe inflation is too many dollars chasing too few goods and services. When that happens, everything becomes expensive too quick, and that's a killer. So how do you fight that? Well, you raise interest rates. Why? Because when you raise interest rates, what happens? I'm going to do a lot of illustration. When you raise interest rates, you make money more expensive. When money's more expensive, there's less of it. Less people are borrowing it. There's less of it in the economy, and so on. And so you fight the too many dollars chasing too few goods and services, or inflation, by creating higher interest rates. Higher interest rates equals less money in the market, in the supply, right? And that's how you fight inflation. That's the Fed's number one mandate. Well, for so many years, 2 decades, it's been this guy that they've been trying to accelerate and spur. Then fighting inflation, it's been trying to create or stabilize growth. Well, how do you do that? Just the opposite. When you lower interest rates, you make money cheaper, and people are more apt to borrow. Corporations, investments, real estate, everything. So it creates more money in the economy, more money in supply, creates a chance for better growth. Now, in 2007 and 2008, the Fed did this with interest rates. They came down quick. They were at, I want to say 5.5%, let's just roughly, and they took it to 0%, and then introduced something called quantitative easing. I'm not going to get into that, but that was essentially to create negative interest rates and really needed to create cheap money because of everything that was going on, started by housing. And, when people talk about the housing crisis that started the financial crisis, money was too available. If 10 people wanted a loan, 10 people got a loan. That's not normal. And so when you had that, you had people then had their interest rates jump on those real kind of cute lending packages they'd put out. And all of a sudden people could afford, foreclosures went through the roof. Next thing you know, the Fed's got to jump in and do something. So they did this every meeting. They even had an intermeeting cut or two through that. They actually had a global rate cut. 6 or 7 global central banks came in at 6 a.m. in the morning Central Time and all cut rates, intermeeting and totally by surprise. And I was not sitting at my desk at 6 a.m. Central Time. There was a guy I knew that was. He bought 1,000 euro stocks, made 100 points or $1 million in probably 30 seconds because he knew stocks were going to love a surprise rate cut, especially from 6 global central banks. Unprecedented in my career. But he always got to the office early, was there at 6 a.m. and took advantage of it because European markets were open. This was 2008, I want to say. It wasn't 07. It was at some point in 2008. So that's what the Fed did. That was their most active period of time because of that whole crisis. They had to do something. And lately, they've taken the rate from 0, and they had negative rates, like I said, with all these bond purchases and quantitative easing. First, they tapered that down and stopped buying as many bonds. Then they started stair-stepping rates back up to its current 2.25, 2.50 level. All right. And this was mostly over the last 17 and 2018. December of last year, they raised rates a quarter point as expected. The president didn't like it. He thought the Fed was too hawkish. I'll get into that word in a second. He thought that was hurting economic growth because when you raise rates, you could affect growth. But either way, they lifted off from 0 to 2.25, 2.5, which is where they're at right now. Now, we're going to go and introduce these two words, hawkish versus dovish. Most of you might know what these mean. If you don't, you need to. Hawkish is simply someone, whether it's the chairman, a Fed official, anyone, economist, you, me, that thinks interest rates should be higher, that wants to raise interest rates or thinks they should be higher, period. Hawkish on rates. Dovish is just the opposite. They think rates are good here or even lower. There's 2 camps. A lot of times everybody is kind of on the same page. Sometimes it's split. And in periods where should we go 50? Should we go 25? Should we go intermeeting? That's when there was a crisis and recessionary type of scenarios or environments where we haven't been in a while. So everything has been pretty transparent as to what the Fed's going to do. All right. In a second, I'm going to get into what's important And that's the words that they speak rather than what they do with rates. Ever since I've been in the business, pretty much, the Fed has been transparent, okay? Meaning you know what they're going to do with rates. It's pretty much priced in. With what they say in the statement could change, but what they're going to do with rates, raise them, cut them, is pretty much known over the 20 years I've been in the business. Before I was in the business, on the floor, it would pop up at the screen. I think it was like 10 o'clock or 10:30. They'd call it Fed time. If the Fed was going to do something, it was at 10:30. Not every day, but certain days. Or it was just not transparent, right? Information didn't flow like it has the last 10 or 20 years. So you know where the Fed is overall more today than you did many, many years ago. But the statement is where the opportunity lies. All right. So when you watch the Fed, and I'm not a Fed watcher, I'm not just dialed in because there's so many resources I've learned to be able to look at that I could very quickly prepare myself for what's expected. But Fed Fund Futures is a market, and I'm going to show you a chart of the Fed Fund Futures, but it shows the percent chance that rates are going to move at future meetings. What do they have priced in? Now, there's a 22% chance that they're going to rate or cut the rate tomorrow afternoon, 22%. That's actually high in the sense that it's usually a lot less than 10. They're not going to do it. It'd be a surprise. It would still be a surprise if they cut the rate tomorrow. All right. I'll get into what future meetings are priced in, but there's actually a market called the Fed Fund Futures, traded at the Board of Trade. ZQ is the symbol, and it prices in the probability, that's the accurate word, of a rate move, up or down. Now, the other thing is not just what they do, but what they say. And that is in their statement. Well, let me just go over this real quick, and then we'll go on to the next slide. Tomorrow is the next meeting, as we know. That's why we're doing this event. 22% chance that they're going to go on June 19th. And then on July 31st, 6 weeks later, roughly, there's an 68% chance they cut. This is all rate cuts. There's going to be no hikes. All rate cuts. In September, 52%. And then it tapers out to 45% and 33%. Now, this is, they're going to go in July. They're going to go again in September. However, it's not 80, 90, 100%, obviously. That's the way the Fed Fund Futures are pricing in the probability of rate cuts at these future meetings, including tomorrow. All right. Now, how do I know that? It's readily available on this particular web page. You guys want me to share it? I will. Just don't go to it now. Hold off, but I'll put it in the chat box. This will take you to CME Group's website about a FedWatch tool about the Fed Fund Futures. And if you go across the top here, see all these tabs? That's tomorrow. And you could see a 24% chance that they're going to go to 2.02 and a quarter. And they always go in ranges. So there's 24% chance that they lowered a quarter because right now it's 225 to 250. 75% chance they do nothing with rates, 24% chance now that they cut it a quarter point. Now, if you tab over to the next meeting, July 31st, there's that 63% number that they're going to have it at 2% to 2 and a quarter. Well, that's a quarter below where we're at now. That's the likelihood rates will be there. So if they don't go tomorrow, this will probably go up. That they're more likely, a lot of the probability from tomorrow will come into this month or this meeting. There's even a 20% chance that they're down at 175, 2% in 6 weeks or at the next meeting. And so you could tab over and see where they're at all the way out till April of 2020. Obviously, the further out you go, the less uncertainty there is, or the more uncertainty there is, and so on. But this is a good, study this particular page, but it's a decent link to go to. and understand where the Fed fund futures are and what they're pricing in. Now, market influence. Before I talk about the statement, I set up these slides to go over what markets are influenced in what ways. You know what? Before I do that, let me skip this slide. Let me go to this slide first. I think this will segue better. So when you're trading an announcement on rates, it's all about expectations. What's priced in? If you don't know what's priced in, cut your mouse, unplug your mouse. There's no reason to even bother trading. You have to know what's priced in or what the expectations are, period. Because if you know what's priced in, then you know what the surprise could be. Trading opportunities always come because the market wasn't prepared. It was a surprise. That's the definition of a surprise. Nobody expected it, right? So the statement is more likely to move markets than the rate changing, because the rate changing generally is pretty transparent and investors know what's going to happen. Tomorrow, a little bit of an exception, 20%, but that's still low odds that they're going to do anything. If they go a quarter point, I'll talk about this in the next slide, that's going to be bullish for stocks, but maybe only temporary, because people might sit back and say, wow, what, are things bad? But I'll get into that in a second. So the statement and the wording on how dovish or hawkish they know what they're going to do with the rate, cut it or hike it, right? So again, with these being the dates at the next meetings, these two, including tomorrow, are going to be pretty important with what they say. You can't prepare for July 31st until we get through tomorrow. And then maybe some comments. If the Fed thinks the market got something wrong, they'll signal stuff in between meetings. One thing I didn't mention is the Fed officials give speeches and generally, won't say anything unless they want to signal something. All right. There's two important testimonies that the chairperson gives in front of Congress that sometimes could be market moving. And I don't want to go over examples of it in the past. It's just, you want to know that Fed governors, Fed officials, voters, non-voters can move the market, especially if they want to. But the statement and what's in the statement has got more volatility and could be more impactful than the rate moving. Now, tomorrow, before we get into tomorrow, let's go back to this guy, market influence. I'll get into that in a second, Rob. The influence that the market has on these various markets. Treasuries. Treasuries are what? Bonds. 2-year, 10-year, 2, 5, 10, 30-year notes and bonds, right? If the interest rate goes up, Treasury prices go down. This is not complicated unless you overthink it. Treasury price, let me just be as simple as possible. Treasuries are products that people issue to raise money, and you have to pay a percentage. You're borrowing money, essentially. So when the government borrows money, at what rate do they issue the bond? Well, the price, if you could take the price from a basis point of 10,000, just for example's sake, okay? And you take 989, okay? Let's just pretend is the price. And you 99.89. And you subtract 99.89 from 10,000, what do you have? 11, right? Put a decimal point there and you put a percentage, 1.1% if the price is 99.89, correct? Let's say the price goes from 99.89 to 99.90, went up, correct? You subtract that from 10,000, excuse my writing, and what do you got? 10. Put the decimal point there, 1%. Price went down. Price went up. Yield went down. All right. Does that make sense? So it's always from a basis point. Don't understand too much about what bond you're trading and all this basis. All you're worried about is, hey, if the rate surprisingly went down, treasuries are going to go up to price in lower rates. So opposite. It's important because treasuries will move more if there's a surprise. So if, let's just take an outlier, if the Fed is really hawkish in their statement, that means interest rates are going to go up. That's as green. That's hawkish. Treasuries will get creamed because prices have to go down in treasuries to reflect higher yields. Make sense? All right. Let me just do this also. This is rates going up. This is rates going down. Thought I'd get cute with red and green, but might not have worked. So treasuries, we know when the interest rate goes up, treasury prices will go down. When interest rates go down, treasury prices will go up. Currencies. Easy way to remember this. The native currency of the central bank doing the talking or the moving will follow the direction of rates. So the US dollar, all right, tomorrow, if this report is hawkish and rates are deemed to be looking higher, the dollar will rally like crazy. Same direction as rates. If the rates go down and it's a real dovish statement, the dollar will get weak and go down. The dollar will, the native currency of the central bank. When the European Central Bank is doing the implementing, whether it's quantitative easing or lowering rates, the euro is going to be affected in the same direction as that rate. Real dovish talk from the ECB, the euro will get weak. So it's about the native currency. Generally, when the native currency goes up, gold prices will go down, and when rates go down, dollar goes down, people go into gold. Opposite dollar, currencies and metals, mostly gold. All right. Stock indexes, which most people in here trade, are going to move in the same direction as rates when it comes to central bank activity. When it comes to economic woes and uncertainty and extreme events like terrorism, there's a flight to quality, and treasuries go up and stocks go down. They move opposite, generally, stocks and bonds. But when it comes to central bank and interest rate movement, they move in the same direction. Remember that, put an asterisk next to it, make a note. That shouldn't be a surprise. So a lot of times when we're talking about when we're talking about like the first knee-jerk reaction in the first few minutes, first 5 minutes, if there's an outlier, you could get a jump in bonds and they lead the stocks in the same direction. So for instance, let me clear all these illustrations. If the stock market or if the bond market goes down, stocks go down, knee-jerk reaction on this statement, all of a sudden the bonds catch a big bid and rally, stocks sometimes will follow, and we'll have a little bit of a bounce. Again, they're going to move in the same direction, knee-jerk wise, for a while after the statement. And someone asked for how long after the statement. It depends on how big of a surprise those words might have been. All right. So treasuries, currencies, stocks, metals, all have different reactions to the move in rates. But if it's not the movement in rates, it's generally the statement and how investors are dissecting that statement as to, was it as dovish as they want? Or was it, you know what, had a little bit of hawkishness to it? And maybe if they for tomorrow, and I'll cover this more in tomorrow's session at 12:30. But if they don't sound like they're going to cut rates in July, stocks will get beat up because they're looking for a rate cut in July 31st. They don't need one tomorrow, but they want one in July. bonds will go down to price in, treasuries will go down to price in higher rates if they don't think they're going to get one in July. That'll be construed as a little bit of a surprise and not what the market wants. Remember what's priced in. What have we done the last few days? Well, really since early last week when Powell signaled that rates were dovish, or that his sentiment was dovish along with the rest of the many of the Fed officials, right? They were waiting for some comments out of him. It was Monday of last week, and we got that rally, or was it 2 Mondays ago? I think it was last Monday. But that was a pivotal moment where the market caught a bid, stock market caught a bid, and they've priced in a dovish Fed. So they want at least that kind of rhetoric in the statement and in any answers he gives to questions at his press conference. The statement comes out at 1 Central and the press conference at 1:30 Central. A couple of times you should always know. That changed, I don't know, about 10 years ago. It used to come out at 1:12, 1:16, 1:17. They never had a set time. It was around 1:15. Then they just pinned it to 1 o'clock Central. They used to have a press conference every other meeting. Now they have a press conference at every meeting. A little more history. It used to be just one-day meetings. They extended it to 2-day meetings during the financial crisis and kept it. A little history for you. Now I'm getting a couple questions. The biggest move in generally is in the short end. So when people talk about the curve, they're talking about the different maturities. Let's just say 2, 5, 10, and 30, Dave, as far as the treasuries go. And not to get too much into yield curve talk, but because we're talking about short end rates, the short end of the curve generally is more impacted. But they'll all move. You'll just get more percentage move generally out of the shorter end. Euro dollars, not the currency, but interest you get on American money in a foreign bank is Eurodollar futures, and it's essentially a treasury market. In fact, that's where I came in 96, started clerking in that pit, in that complex. But that's a very short end maturity and whips around. Now, the yield curve, you do a whole webinar on the yield curve, and you don't really have to understand that much about the yield curve unless you trade it, is essentially the 2 versus 10, let's say. Generally, you're going to get what? You're going to get a higher yield the longer you lend someone your money, right? If I let you borrow my money for 10 years, I want more than if I lend it to you for 2 years. So generally, the yield curve looks like that. When they say it gets inverted, that means the 2 is yielding more than the 10. Sometimes that signals a recession, or oftentimes it does. I think the 3 and 10 year got inverted, not the 2 and 10, but the 2-10 got close. Doesn't mean a recession, oftentimes signals one. But that's the yield curve. When they talk about that, it's the relationship of yields as you go out in maturity. So the shorter end will tend to whipsaw a little bit more. And then oftentimes if you really get into it, you get the 2 year that's weak. Here, if I draw it, you guys will kind of get a sense. Let me do it with arrows. So the 2 year goes down a lot, and the bonds went down, but only went down a little relative. You know what I mean? So you'd be able to say the 2 year note was a lot weaker than the bonds. Therefore, the yields in the 2 years went up, and the curve is flattening. Don't get too confused about that. Once you start understanding the opposite relationship, bond prices with rates, everything else kind of falls into place as far as that goes. The Fed balance sheet, Rob. So the Fed balance sheet they were, as far as back in 2008, November in 2008, I remember like it was yesterday, is when they went to zero rates, and then they introduced this thing called quantitative easing, which were more tools that they had in their arsenal to really help the economy from going to a depression or into a depression. And they bought all kinds of bonds, or they had bond purchasing programs in $100 and something billion. In March, I want to say, of 2013, I could be off on a date, Bernanke was the chairman, and he began on a congressional testimony said we're going to taper. That was the word he used. That was when markets were signaled that they were going to start reducing how many bonds that they were going to purchase at each meeting. And so if there's any talk, Rob, and this is a good question, that they're going to take on more, that's dovish, less, that's hawkish. I don't know if the balance sheet's going to play a role tomorrow, but I do. My first knee jerk when I'm preparing for this is what's the, to me, the most obvious surprise. It might be an oxymoron. Obvious surprise would be they're not dovish and they start reducing the rate cut chance in July. That would be bearish for stocks and bonds. Dovish, I'm sorry, they're not as dovish, so that means there'd be hawkish. Hawkish means bearish for stocks and bonds. Hawkish, bearish, dovish, bullish. To really confuse you guys, you gotta, like I said, know what's priced in, and stocks are pretty strong. They got some tailwinds with the conversation Trump had with President Xi in China this morning, but they were strong about a week and a half ago when Powell shifted gears and really kind of validated that they had a chance to cut, because 2019, coming into this year, 2019, the Fed was going to be neutral. They raised a quarter point in December. A lot of people think that they shouldn't have, but they were going to remain neutral in 2019. And now here we are halfway through 2019 and not as neutral anymore. And now there's a chance, 65% chance of a rate cut in July, late July, when they meet. Now, what do I want to show you guys? Oh, real quick, a Fed Fund futures chart. I don't watch this chart a lot. I'm just going to show you when it goes up, they're expecting rates to go down. That was Powell's talk. It was a couple weeks ago. That's when they got out of this range. You know, we talked about consolidation boxes. There's one long one, and they broke out when Powell got dovish in that speech he gave. But this is essentially what the Fed funds are doing in relationship to the percentage of probability if they're going to go or not, that other link that I showed you guys. Now, when you ask, how do I get this news, trade this news, hear this news, and everything else? I use a service, and you don't have to use this service. You use a service called Trade the News, which puts out headlines like this. They squawk it out if it's something important, and I click that, and now I'll hear him if he says anything. In fact, I'll share it with you guys. If he says anything, you guys will hear it on the in the webinar. Just to give you an example, when they highlight it, it's supposed to be a little bit more important. But you can click in, and down in here they elaborate on the story. They give you a calendar of events and everything else. I'm not going to get into this. I'm going to get into this because this is the first reaction or information I get as to what the statement is, what the highlights of the statements are. Obviously, if they move the rate, and then any comments that come down the wire, like Trump's tweet. You following his Twitter is best, but then you have to listen as close to real time as you can for someone to essentially slap you in the head and tell you to pay attention. And I've been using these guys for a long time. Now, before this, when I worked at the prop firm, we had this in two guys that I told you about. Scott and Scott were their names. Two of the smartest guys I know, not only because they knew a lot about this, but they could explain it well. They articulated it really well, and they traded it well. So they weren't these stuffy economists that really don't have any idea about true investing and certainly trading. They understood these headlines and this information as traders, and they were able to convey it really well to us. And that was it really upticked my understanding of fundamentals and what to pay attention to, and create the simplicity of That's bullish, that's bearish without having to think. And that's important. So if you go back and you look at this, they also have, where is it at? This is kind of cool. If there's a big move, you could scroll over it and see if news were due or were part of it. And it was. Draghi had some comments that moved this was the euro. So he had some dovish comments, Draghi. The native currency of the ECB is going to be the euro, right? Look what the euro did at 3 a.m. this morning, because he was real dovish in his comments. And he's the Jerome Powell of the European Central Bank. So the euro went in the direction, the native currency in the direction of rates. And you could see they slammed them. So it's kind of cool how they plot if there was a news event or alert that came out when a market moved a lot. What's important is market reaction. When it's chopping and not doing anything, don't overanalyze. But when you're able to see a big move, hopefully you could catch it. But if not, you say, well, what are they pricing in? Is this a reprice type session? Is gold pricing in something or what is it, right? What are they like 2 weeks ago, they priced in Powell's comments and they priced in this dovishness that they hope to get tomorrow in the statement. I'll have some more detail about what to expect tomorrow when we preview, and then you'll hear this in the background as we approach 1 o'clock, and then right at 1 Central, you'll hear this guy squawking out what's in the statement, what's important, what are the headlines that are dropping. And then we'll watch I watch the bond market a lot closer to try to catch some leadership in the treasuries for stocks. It was one other thing I want to show you. Forget. Let me pull this aside, because that's important when you're trading a scheduled event, and it's important for unscheduled events. For instance, like Trump's tweet that he talked to Xi. All right. Now let's get rid of this for a second. And let's go to the charts that I showed you guys earlier today. And just because many of you guys watched the order flow pattern video, let's see if there was any pattern since we left. And because there were some breakouts, where the stops started, I'm trying to find a pen, seemed to work decent. There were some stops that got elected in there. I could show you on the footprint in the last hour. You could see how they held as overhead resistance. There was a long down up bar that did not work right in here. This should have been a transition to leak up, but it was in like the last 10 minutes, and usually it whipsaws a lot. I actually had to go down before it went up. So just a couple of examples when it breaks out. Let me show you this on a footprint chart, because you could kind of dissect and look inside the footprint to see if the speed picks up, and that's what's important. So you see, don't worry about all these numbers. Just see how it gets red in there? That means the market a little fast on the downside. That's why I could draw a line across from where it got red, and why it worked as decent resistance at around 22.5 just before the cash close. It's kind of where the stops started type of pattern. Here's another one. It gets fast in here. They stop them in here. They stop them in here as resistance, send them lower. So you look at the beginning of a breakout, if it came out with some speed, and this footprint kind of shows, a breakout in here. This might be tough if you've never seen a point and figure a footprint, but the market rallies in here, rotates down, stops, rotates up, down, stops, up, down, up. That's how you read the rotations. Forget about all the numbers. Don't let that confuse you. All of these columns do this. Look at the line I'm drawing in. That's the snake, or the rotation you want to follow. I always tell people, in order to trade a market, you got to follow a market. If you can't follow it, you can't trade it. Now here's a breakout. Didn't work that great right after we said goodbye at, I don't know if we were still doing that earlier webinar, but it broke out in here. this thin spot held as some okay support, no, and actually, or okay resistance, but really not so much because it rotated down and then spiked up into here, which wasn't that bad. Like, see how fast it gets there as it's wiggling down? And that's what sent this red across 24.25 even. Where the stops started. Once they come out, stops are usually indicative of the market picking up speed. You're going to see a lot of this tomorrow. You're going to see this footprint jump around quite a bit. And all we're trying to do is see if it gets too cheap, too expensive, and we could catch a turn maybe off some leadership with the bonds or the dollar, because we know what they're supposed to do. If the report is not dovish, that's weakness. And we could talk about what that might read like tomorrow at 12:30 when we do a quick preview into it and then trade it, analyze it in real time. But that's a general overview of the central banks. You guys got any questions? You don't have to understand central bank activity as an economist. And guess what? If you understood this webinar today, you know more than the people that are on Fox Business or CNBC. So, good question. The fact that we gapped up higher prices in the dovishness. So, what that means is they're really expecting a dovish statement tomorrow. If they don't get it, there's just more downside. A hawkish surprise would create more downside if we priced in dovishness. So that's the kind of the value you get from that. In the prop firm, we waited till 2 hours before the Fed release before we had a meeting because some things could change, and the analyst wanted to make sure he had all the information before he. And we didn't meet on this a week or even a day before. That's why we're going to meet again at 12:30 to really take a look at what the market's done yesterday, meaning today, and then in the first half of the session in the morning leading up to the 1 o'clock release. Here's another thing about statements in central bank. They were our best days as a prop firm, and they were our worst days as a prop firm. I remember the owner saying, he says, we have some of the best historical up days on statement days, and we've had some of our worst days. And he went on to say, if there's an outlier, if there's a surprise, we have our best days. If there's not, people force it, trying to make something happen, and we have our worst days. You could always get a dud, is what he was trying to say and what I'm trying to say. So you're expecting all this volatility, and you're all geared up for it, and you get nothing. If tomorrow is more dovish, Red, yes, the stock market and bond market will rally. Like if they cut, let's just talk about if they cut the rate tomorrow. Initially, stocks will rally because that wasn't priced in. And a rate cut's dovish, right? It's lower rates. However, the knee-jerk reaction will be a rally for stocks, but there's always a chance people are looking around and saying, wait a second, why are they cutting? What do they know? Is there something bad out there? And then stocks might start going lower. That's always the risk. Now, this afternoon, we got some commentary on the wires, and I'll read it to you. And this was all throughout today's session. Let's see what Fed Chair Powell does tomorrow, responding to a question about report. White House looked at the legality of demoting Powell. That came out right in here at 10:25, and we discussed it a little bit in the earlier session that we had. But that's bearish for stocks if they're going to interfere. There's always supposed to be that separation between a central bank and the executive and government in general. They're supposed to be an independent entity. And so the market doesn't like that uncertainty. Anybody else got any questions? Let me scroll up to make sure I didn't miss any. It's going to be the same link to get into the 12:30 event, 12:30 Central, 30 minutes before they release this statement. I decided to do this on the Fed because I think that the next two meetings could be volatile. There's some uncertainty going into what they're going to do and everything else. So that's why I did this central. But you have to know the simplicity of, who the players are. There's a press conference a half hour later. There's two semi-annual testimonies that the chairman gives. There's other central banks that could do stuff that move our markets that you should be aware of. ECB on Thursdays once a month, Bank of England on Thursday earlier in the session. And they're really their economic conditions sometimes are different than ours. So they're dovish, we're hawkish, we're raising rates. They were cutting rates over the last couple of years. Some background that you need to have that I hope most of this webinar gave you guys if you didn't already have it. And we'll cover more detail. Again, the recording for all these three events, I'll email all together. So the trading room guys, we'll see at 8. Everybody else, same link. You'll get a reminder. You should get a reminder 1 day and 1 hour. Well, not 1 day because we're past that, but 1 hour before the event, you'll get an email. Enter through that, 12:30 Central tomorrow. Read up on some of the stuff that I talked about. Don't ever get too deep. Don't ever think you have to be an expert because experts don't make it in trading. You want to be an expert, go become an economist or a chemist or a doctor, but not a trader. Have a safe night, guys. Have a pleasant evening. We'll see you tomorrow afternoon. Thanks, Glenn. Glad you liked them. We'll see you guys tomorrow.